Okay, welcome back to the part 2 of chapter 8, and we're going to talk about the contingencies. It's a part of belonging to part of short-term liability, right? Current liability. Okay. So first of all, we wanted to apply appropriate accounting treatment towards the contingencies, and then the methodology and the philosophy is just conservatism. What I mean by that means that you record um, liabilities as early as you can. And in another way, is thinking about it is actually, um, but however, what kind of liability is able to contingent liability is able to be recorded, and then we needed to consider there the probabilities of these things happen and estimatability of um, these contingents. So let's keep forward. So contingent liability is an existing uncertain situation that might result a loss, right? Depending on the outcome of the future event. So the likelihood of the payment, which is because the uncertainty happened, it will cause us a loss. So there's a three level. One is called a probable level, another one called a reasonable possible, and then another one is called a remote. So probable means very likely to happen. Reasonable possible means more than remote but less than probable. Let's say probable is equal or bigger than 90% of time this thing will happen, and a reasonable and a remote means that less than 10% of the opportunity that the chance is like that are gonna happen, and a reasonable possible is gonna be between 10% to 90%. But this threshold is actually not a fixed threshold. This is just an example because towards different scenario, the probable and the remote could be 100% different. I give you a number here just to let you know that's what it meant. Okay, and then among the payments is what I meant here is the two scenarios you need to consider when you're considering whether there's a contingent liability. One is the probability of that event. Second is the amount of the payment that is associated with when that event is actually going bad. So first of all, the amount of payment can be reasonably estimatable, right? And it can also not reasonably estimatable. Hence, if a contingent liability is probable and at the same time amount is a reasonable estimatable, and then that means that we can record it as a loss. We need to recognize as a loss. Right? So because first of all we know how much the damage is, at the same time it's very likely to happen. We want it to be conservatism, and then hence we wanted to record loss as early as we can. So here has a very good summarize of how we do contingent liability recording. First of all, if it's a probable likelihood of the payment, like cash outside flow outside, is probable, and the reasonable estimatable, right? The amount is estimatable, hence the liability should be recorded immediately. But if the contingency event is probable, however, it's not reasonably to be able to estimate how much the loss is, we do need to disclose it, but we do not need to record a journal entry. Okay? And when it's actually reasonable possible, and we also can understanding how much is actually gonna cost us, then we will disclose it only. Okay? When it's actually not able to estimating, while it's reasonable possible, we also want to disclose it as well. However, when the likelihood of this contingency is very remote, such as less than 10%, and then we don't need to disclose anything. We don't need to disclose anything whether or not it's estimatable. However, when it's probable and it's estimatable, we want to record a journal entry on the year end by debiting loss to recognize the loss, which will hit the income statement to reduce net income, right? At the same time, we want to credit a contingent liability account, which is the current liability account, right? It's a short-term liability for $100. Okay, so now we wanted to look at the warranties. So a lot of times that when we buy stuff, we are warranted. We give 1 year warranty, means that it can either come back to repair it or you can replace it, right? So assume that warranty costs are estimated about 3% of the sales all the time. The December sales is $1.5 million, and customer make warranty claims about $12,000 in January of the following year. So what will we do at the year end? First of all, we wanted to recognize warranty expenses based on our estimation of 1.5 million multiple 3%, which is $45,000, and we credit warranty liability. This is a new account that we introduced, okay, in this chapter. It's a short-term liability, okay? However, when January 30th, when people really come back, when people use warranty, we wanted to reduce its warranty liability and credit in cash, right? We want to give the customer what the warranty promised to do, right? So this, do you feel like it's a little bit like accounts receivable? So when real bad things happens, the allowance account is actually the ones actually get debited, right, and credited in accounts receivable, kind of like that. And then the real hit to the income statement is happening before the event is really happening. Same idea here. Before anything really bad happen, when people come back to make the warranty claims, we already record the warranty expenses in the year that when we sell stuff, right? However, when people come back to use the warranty, actually use it, we wanted to reduce the warranty liability and credit in cash. As you can see, the interesting part is on December 31st, our warranty liability is $45,000. However, during the first months of January, we only used the $12,000. Hence, by end of January 31st, our warranty expense, our warranty liability is actually only $33,000, right? So, some students think that the balance of warranty liability account is always equal to the warranty expenses account. That's not the case. The warranty liability account is increased when there's estimated warranty liability is recorded, right? So when we actually write down warranty expense and we credit warranty liability, this is actually when liability is increasing, right? This account is increasing. However, when it's reduced, it's because we really pay out the liability when actually happen, right? So therefore, sometimes the actual and estimation does not really equals to each other, does it? Right? Sometimes it's going to differ. Hence that expense, warranty expense is not going to 100% equals to warranty liability all the time. Okay, let's look at an example. Which of the following statement is true with respect to the warranty liability? A, warranty expenses needs to be recorded in a period warranty repairs is made. No, right? B, warranty expenses account balance will always equal to the warranty liability account. No, right? And then C, the warranty liability account is debited when the actual repairs happens. Yes. Okay. So during the first year of the business, Oceanic Inc. has a sales of $300,000 and pays warranty claims of $10,400. Oceanic offers a 1 year warranty. Anticipated warranty cost is about 5% of the sale. So let's say 5% of 300,000 is actually $15,000, right? And $15,000, it says it's already used 10,400 of it, right? because they come back to claim that thing during the year already. So that means what the balance of the ocean's warranty liability is at the end of the first year, it should be only equals this, because this is during the year the customer already come back for it. To use warranty, right? So this is what left of the promised amount of $15,000. Okay, very good. Okay, so then you will ask me, are we always only care about the contingent loss and not worry about the gains? Of course we're gonna worry about the gains. Of course we would lovely to record gains if any existing uncertainty situation that might result a winning situation, right? So for example, in a lawsuit, the defendant faces a contingent liability, while the other side, the plaintiff, may have a contingent gain if we win the lawsuit, right? However, when we record the contingent gains, we are using the same thing applied to conservatism. We do not want to record gain unless we are certain. Okay, so we are probably we are win. Then we record. You cannot say remote the chance. There's a remote chance that we will win this a lawsuit, and then you record the gains. Okay, so the key points that unlike the contingent liability, contingent gains are not recorded until the gain is certain and no longer a contingency. Okay, so very important. Okay, liquidity analysis. Liquidity analysis means we wanted to assess liquidity by using current liability ratio. So what is liquidity? Liquidity refers to having a sufficient cash or cash equivalent or other assets to pay current maturing debts. So when a firm lack of liquidities, it can result in difficulty for the pay to the bank or even bankruptcy. So for example, when your interest amount is due or credit card is due, you have to have enough cash to pay for the current due amount of the credit card, right? Otherwise, if you are delinquent for like more than 6 months, the credit card company will call you saying that you have to liquidating your assets, right? So in another word, that or you can open another credit card to pay for this credit card. So that's why a lot of people have so many credit cards. It's debt over debt. But in terms of a firm, so when you lack of liquidity, it can result in financial difficulties, such as you cannot pay employee, you cannot pay vendors, right? And then you cannot pay bank. In the end, you have to file bankruptcy. So liquidity is very important, and we have 3 measures to measure liquidity. First, working capital. Second, current ratio, and third is asset test ratio. Okay, what is working capital? Working capital equals current asset minus current liability. It's a measure of current assets remaining after the paying the current liability. It's whatever is left over if you paid every current liability, right? So a large positive working capital is an indication of good liquidity, right? Because you have a lot current asset more than the liability. But however, it's not the best ratio to measure the liquidity, because it cannot comparing companies to companies. Because the ratio does not really control the relative size of each company. For example, a small company has a working capital of 1 million, right? And a big company have a liquidity of 1.5 million. So, but if you do not consider the size of the company, you just look, 1 million is smaller than 1.5, hence A company is actually not as a good liquidity as B. Wrong. A company is great because the size of the company is really small. For having a $1 million working capital, that's amazing. However, you look at the big companies only have 1 million of working capital. That's something worthy of worry, right? Okay, so then to improve our the comparability across the companies, there's a ratio we can use. It's basically using current asset dividing current liability. For example, amount of current asset available for every $1 of the current liability. So basically, $1 of current liability, how much dollar of current asset you have per $1, right? So a higher current ratio, the greater the company's liquidity. In pandemic, companies' liquidity should be under a very tight scrutiny, right? Because a lot of people is running out of cash. And the current ratio for say if it's 1.5 is indicating for every $1 of current liability, the company has $1.50 to pay it off, to reserve to pay for that a dollar of current liability. Okay, the general rule is that the higher current ratio is actually the better, but high current ratio is not always a positive signal because company have a difficulty because remember the current assets is actually including accounts receivable and inventory, right? When you have these two items, when you have a current accounts receivable outstanding, that means if you have too much of this, that means your collectability is really low, right? That's not a good thing. And when you have a too high inventory, that means that your inventory is obsolete. It's staying in the warehouse too long. It's de-evaluating, right? It's wearing out. Hence that manager must balance incentive for a strong liquidity, which is a high current ratio, right? If you wanted to make sure that you have a high liquidity, that's fine. However, you have to also minimize the receivable and the inventory level. In other words, the better it is cash as current asset, the more the better. But if you are stuffing the current asset with obsolete inventory and accounts receivable, that might not necessarily is actually a good sign. And another interesting test is called asset test ratio. Is basically specifically pointing out the current liability that's most efficient, most convertible current assets such as cash and current investment and accounts receivable, dividing the current liability. This ratio means the amount of quick assets available for every $1 of a current liability. So what is a quick asset? Quick assets are the current assets more rapidly to convert to cash. So we excluded from the current assets such as inventory and prepaid rent. These items is relatively slower to convert into cash. So by excluding less liquid current assets, the asset test ratio may providing a better overall indication of company's liquidity. So the key point here we want to take away is that working capital is the difference between the current asset and the current liability. The current ratio is equal to the current asset dividing current liability. The asset test ratio is equal to the quick asset, also means cash, current investment, and accounts receivable dividing current liability. Each measures a company's liquidity and its ability to pay for current maturing debt. Okay. So current ratio is computed as difference. No, this is working capital, right? And computed as current asset dividing current liability. Yes. A measure of profitability. No, it's a measure of liquidity, right? And yes. Okay. Liquidity management. Management can influence the ratio that measure the liquidity to some extent. For example, a company can influence the timing of inventory and accounts payable recognition by asking suppliers to delay the delivery of the schedule from December last year, right? Last year's December to next year's January. By doing that, it can reduce the balance of the inventory accounts payable at the same time changing the current ratio. This is very interesting. This is also we can call the liquidity management. People intentionally to managing the liquidity ratio of the year end. So for example, if nothing being done by the management, the expected end of the period, which end of year current ratio is 5 million, which is current asset, dividing current liability is 1.25, meaning $1 of current liability can be paid by $1.25 of current asset. And the company decided to delay recipient of $1 million in goods until the following year. So the management wanted to managing the liquidity ratio by delaying recipient of $1 million of inventory until next year. And then by doing that, the current asset and current liability are both reduced for 1 million. Hence, 5 minus 1 is 4, 4 minus 1 is 3. So when 4 dividing 3 is actually 1.33. So therefore, the current ratio increased just by asking the vendor to delay the shipping across the year, right? So across the year. So this is year 1 and ending year 2. So he said, do not deliver me anything. So by doing that, the current ratio of current year 1, it becomes 1.33. Okay, so I think this is pretty much we covered for the chapter 8. Chapter 8 is relatively easier, basically understanding what is the current liability, understanding the payroll taxes and sales taxes, and we also wanted to tell you what is a operating cycle and what operating cycle meant in terms of category the current asset. And then later on we talk about the contingents. How do we record a contingents liability, and how do we record a contingents gains, and we're understanding what is the warranty, what is the journal entry for warranty, and in the end we give you several ratios for you to analyzing the liquidity of the company, right? And then show that liquidity can be managed by the management, right? Can be manipulated by management. Just because you delay to deliver $1 million of goods, you can inflating your current ratio from 1.25 to 1.33. Okay, so I only plan to spending one class for this chapter, and I believe listening this lecture might be benefit for you, and I will see you guys in chapter 9. Thank you.